Most people think dividend investing is simple. Just look for the highest yield. But here's the uncomfortable truth. The stocks with the highest yields are often the ones closest to a dividend cut. If you've ever wondered why a stock shows an 8%, 10%, or even 15% dividend yield, but somehow nobody talks about it, there's a reason. Behind the scenes, the company might be struggling, losing money, drowning in debt, or about to slash the dividend entirely. Today, I'm going to explain, in the simplest way possible, how dividend yield actually works, how to calculate it, and most importantly, what a good, safe, realistic dividend yield looks like right now in the US market. Because once you understand this, dividend investing becomes one of the easiest ways to build passive income, the safe way. Let's break this down step by step. And also, I am giving away a free dividend calculator that shows your yield, income growth, and long-term dividend projections absolutely for free later in this video. If you only remember one formula from this video, make it this one. Dividend yield tells you how much cash a company pays you every year compared to its current stock price. The formula is dividend yield equals annual dividend divided by current stock price. So if a company pays $4 per share per year and the stock price is $100, the dividend yield is 4%. Simple, right? But here's what most people overlook. The dividend stays the same, but the stock price moves every single day. So the yield is constantly changing, just like blood pressure or a heartbeat. If the stock price falls, the yield goes up. If the stock price rises, the yield goes down. This is why yield can be misleading if you don't learn to read what's happening behind that number. A 7% yield might look attractive at first glance, but you'll see later why it can be a screaming red flag. There isn't just one kind of dividend yield. There are two, and they tell different stories. Trailing yield. This is based on the past 12 months. It tells you what the company actually paid. It's factual, verified, and stable because it looks backward. Forward yield. This is based on future expected payments. It uses the most recent dividend announcement and projects it forward. If a company just raised its dividend yesterday, forward yield updates instantly. Trailing yield does not. Most serious dividend investors use forward yield because investing is about what happens next, not what happened last year. Think of trailing versus forward like watching the replay versus watching the live match. Both matter, but only one helps you make your next move. Hey, I built something super useful for your dividend investing journey, and I'm giving it to you completely free. This is my dividend yield and dividend income calculator. It helps you instantly see how much income your stocks can generate and how your yield changes as prices move. All you do is enter three things: the stock price, the annual dividend, and how many shares you own. That's it. In one click, it tells you your dividend yield, yearly income, monthly income, even daily income if you want. This tool helps you understand real cash flow, plan for long-term dividend growth, and avoid getting fooled by risky high yields. Download it free. The link is right below in the description section. Make your investing simple and let your money work for you. If this tool was useful, then please let me know in the comment section. Before you ever trust a dividend yield, you must check one thing: the payout ratio. The payout ratio measures how much of the company's profits go toward dividends. Payout ratio equals dividends divided by earnings. Here are the comfort zones. 40% to 70% equals very healthy. 70% to 90% equals caution. 90% plus equals high risk. 100% plus equals unsustainable. If a company pays out more in dividends than it earns, where is the extra money coming from? Usually debt, or cash reserves, or financial engineering that cannot last. Real examples: PepsiCo has had payout ratios above 100% at times. A red flag. Altria runs a very high payout ratio, but gets away with it because the tobacco business has extremely predictable cash flow. Cogent Communications showed a near 19% yield because its payout ratio was exploding, and the stock price was collapsing. These numbers don't lie. If the payout ratio is too high, the dividend is on borrowed time. By the way, if you're finding this helpful so far, a quick subscribe and like on the video really supports the channel. Here's a mindset shift most investors never learn. The best dividend stocks don't start high, they grow. Dividend growth stocks typically start with yields around 2 to 3%. Not exciting, right? But they increase their dividends every single year. For example, a company yielding 2.5% today that grows dividends 8% per year will be paying you more than 5% on your original investment after a decade. And that's without the stock price needing to rise. Meanwhile, high-yield stocks, the ones that pay 6%, 7%, 8% immediately, might look tempting, but many don't grow at all, and some collapse. Dividend growth plus time equals wealth. High yield plus risk equals stress. This is why the richest dividend investors in the US focus on companies like Procter & Gamble, Johnson & Johnson, Coca-Cola, and Microsoft. They grow, they compound, they raise your income even while you sleep. Let's talk about today, right now. What yield is actually considered good in 2025? Here are the real numbers from the US market today. S&P 500, approximately 1.2%. Dow Jones, approximately 1.8%. SCHD ETF, approximately 3.4 to 3.7%. VYM ETF, approximately 2.5 to 2.8%. 10-year Treasury, approximately 4.15%. Treasuries matter because they're risk-free. If bonds are paying 4%, then a stock must pay more or grow faster to justify the risk. So in today's market, 2% to 4% is healthy range for big blue chips. 2.5% to 3.8% is a great range for ETF investors. 4% to 6% is high yield but potentially stable. Utilities, REITs, energy. 6% to 8% is high yield with added risk. 8% plus is danger zone. In 2025, a good yield is anything that balances risk and return, not the highest number you see. So why do some stocks have insanely high yields? 10%, 15%, even 19%? Because the yield can explode when the stock price collapses. Imagine a stock paying a $5 dividend when the price is $100. That's a 5% yield. But if the price crashes to $50, the yield suddenly becomes 10%. Nothing magical happened. The company is just losing value. This is why ultra-high yields almost always signal trouble. Some warning signs: revenues are falling, the company has too much debt, the payout ratio is 100% plus, cash flows are shrinking, stock price is collapsing, industry is in decline, management hints at dividend cuts. Examples include telecom companies with 15 to 18% yields, business development companies yielding 19%, distressed financials offering double-digit yields. These aren't opportunities, they're warnings. When the dividend gets cut, the stock price usually drops again. That's a double loss. Dividends aren't about luck. Different sectors naturally behave differently. Here's what 2025 looks like. Utilities, approximately 3.1%. Stable, regulated, predictable. REITs, approximately 4.3%. Legally required to pay 90% of income. Telecom, approximately 4 to 7%. Subscription revenue plus heavy debt. Consumer staples, approximately 2.5%. Coca-Cola, P&G, PepsiCo. Energy, approximately 4 to 6%. Cash flow depends on oil prices. Healthcare, 1 to 3%. Steady earnings, lower yields. Technology, 0.5 to 2%. Growth first, dividends later. So, if you see a tech company paying 5%, something is wrong. A utility paying 1%, probably overpriced. A REIT paying 9%, high risk. A telecom paying 12%, big red flag. Knowing sector norms protects you from comparing the wrong things and getting burned. Let's look at a few companies known for consistency, not recommendations, just examples. Procter & Gamble. Yield around 2.5%. 69 consecutive years of raises. Household brands you use daily. Coca-Cola. Yield around 2.9%. 62 years of increases. Global demand, recession resistant. Johnson & Johnson. Yield approximately 3%. One of the safest healthcare dividend payers. Dividend King. Verizon. Yield approximately 6.8%. Slow growth but strong cash flow. Realty Income. Yield approximately 5.6%. Pays monthly. Known as the monthly dividend company. These companies don't offer shockingly high yields, and that's exactly the point. Consistency beats excitement. Now let's flip it. These are the kinds of yields that look juicy, but come with danger. Oxford Square. Capital Corp yield approximately 19%. High leverage, high credit risk, dividends unstable. Cogent Communications. Yield 18 to 19%. Stock price crashing, dividend sustainability questionable. Distressed telecoms and BDCs, yields 10 to 20%, often rely on debt, highly sensitive to economic downturns. These are the stocks beginners buy because they think, wow, 15% yield, that's amazing. But without understanding why the yield is so high, they walk straight into a trap. Remember, high yield isn't bad, unsustainable yield is. How to know if a dividend yield is actually good? Let me give you the exact checklist I personally use. Flow. Compare the yield to the stock's own history. If a stock normally yields 3% and suddenly yields 6%, look deeper. Compare it to the sector average. A REIT at 5% is normal. A REIT at 12% is distressed. Compare it to Treasury yields. If Treasuries pay 4%, a stock yielding 2% must have strong growth. Check the payout ratio. 40% to 70% equals ideal. Above 100% equals danger. Check cash flow. Free cash flow must comfortably cover dividends. Check revenue and debt. Declining revenue plus high debt equals high risk. Using this checklist makes dividend investing safe and predictable. If this checklist makes dividend investing simpler for you, consider subscribing. I make videos exactly like this every week. Let's wrap everything up in a simple, clear roadmap. Dividend investing isn't about chasing the highest yield. It's about finding companies that pay you consistently, grow their dividends over time, and give you peace of mind. When you combine steady yield, strong dividend growth, healthy payout ratios, realistic expectations, you build a stream of income you can rely on for years, even decades. That's the simple money method. Make money simple, make investing calm, and make your financial future something you can feel proud of.